Welcome all to the brief presentation of Monetary Policy Statement of Financial Year 2021. This is a presentation by Bangladesh Arek Abdullah Faisal, the chief contributor of Bangladesh Arek Cleans. My message for this monetary policy statement is this is a proactive and expansionary monetary policy, and to me this is a very timely policy response from Bangladesh Bank to combat with COVID-19 and floods. If Bangladesh Bank keeps the short-term risk-free rate at 4.75%, there should be an adequate flow of private sector credit and the market of financial assets should get a much needed relief. The repo rate was cut 15 basis points to 4.7% when Bangladesh Bank unveiled monetary policy statement for fiscal year 2020 to 2021, and for that particular reason I'm calling this is expansionary monetary policy. The latest cut, which stood at 6% before the pandemic, will inspire confidence among the banks and business alike. So what is repurchase agreement? This is a form of short-term borrowing for dealers in government securities. In Bangladesh, the repo rate is the central bank rate, which is the rate that is used to implement or signal the monetary policy stance. The central bank also cut the reverse repo rate by 75 basis points to 4%. A reverse repo agreement is a purchase of securities with the agreement to sell them at a higher price at specific date in future. In Bangladesh, bank deposit their money with the central bank at a rate set by the central bank. Central bank uses reverse repo to increase the money supply by open market operations. Bank rate was also slashed by 100 basis points from 5% to 4% in this monetary policy statement. Bank rate is the interest rate at which Bangladesh Bank lend money to domestic bank, often in the form of very short-term loan, which is another major tool for the Bangladesh Bank. It was cut yesterday after 17 years as part of the expansionary monetary policy. Bangladesh Bank on a whole uses the rate while giving out money to banks under its refinance scheme. The central bank has recently cut cash reserve ratio from 5% to 3.5% to provide adequate liquidity in the money market, and to increase more liquidity for banks. It raises the advance to deposit ratio for private commercial bank from 85% to 87%, and for Islamic Bank it raises the investment deposit ratio to 90% to 92%, and it's continuously buying forex dollar from the forex market to provide more liquidity in the money market. The last year targeted inflation was 5.5%, but actually we achieved 5.65%, which is much higher than the targeted inflation, and thanks to the food inflation, which actually represents 52% of the total inflations. Inflation increases because due to the rise increases rise price of the rice, as well as protein item including vegetables and fishes as well. Bangladesh Bank predicted 5.04 to 5.93% inflation for the next financial year. Is it possible to keep inflation in this range? It is too earlier to answer this question because it depends upon a number of facts. The first thing, will have to look at the global oil market. Though the global oil market is in downward trend for a longer period of time due to the war between China and USA, and after COVID-19, the oil price goes to its bottom. So we have to look how many days it will take to revive the overall global economy from the COVID-19. As long as COVID-19 is not contained, oil price will be is in this range, which will help us to maintain our inflation level to this level. But another thing we have to consider at the same time, the flood, which has created a lot of supply shock in these days. Lots of crops and lots of land, agricultural land has submerged by this flood, and there might be some sort of supply shock for this flood as well. So keeping two things in mind, I think the inflation level will be 6% in the next financial year. Besides, BB is also injecting fund to financial sector as part of its effort to implement the stimulus packet, but business continue to show little interest in taking loan from banks, leaving them with excess liquidity. So the latest initiative is more for actually optimism for the business and banks. It sends out a positive signal for all the parties involved in the money market and capital market as well. The latest BB policy will play a vital role in increasing both the reserve and broad money supply to the financial sector in the days ahead. The last year broad money targeted was 12.5%, and actually we achieved 12.7% broad money growth. And for this year, for the first half of the year, broad money growth target is 14%, and for the next part of the year it is targeted 15.6%, and this will be actually required to raise the private sector investment, because when the money supply will be growing, then there will be higher money in the banking channel, and they will be able to give loan to the private sector. So by considering the private sector credit growth, we have to increase broad money growth. No, we have to increase the broad money level from the current. So the next thing is that reserve money. Reserve money or the central bank money represent the base level for money supply, or it is the high powered component of money supply. Broad money depends on the volume of the reserve money, and this is a multiple of reserve money as well. The growth rate of reserve money stood at 15.7% in financial year 2020, up from 5.3% a year ago. The supply of reserve money increased significantly last year as the central bank circulated the currency to the financial sector to mitigate the fallout. The BB has also set an reserve money growth target of 13.5% for the next fiscal year. Reserve money might surpass the growth set by the central bank, as both the net foreign asset and government borrowing may increase significantly this fiscal year. The net foreign asset traditionally increase when GDP growth faces crisis, as this has harmed the import and the level of confidence for the foreign investor. Also, bank now enjoy huge liquidity. They will show little interest in investing their fund in treasury bill and bond in the days ahead due to the declining trend of the interest rate on the government securities. Against the backdrop, the central bank will have to provide the fund to the government by using the reserve money. The government has set a target of bank borrowing target of 84,980 crore to meet its deficit financing of the fiscal budget. Thus, the central bank has set a public sector credit growth target of 44% for the fiscal year 2020 to 2021, up from 53.3% a year ago. Public sector credit may be higher than the target set by the central bank, as the government continues to show frustrating performance in mobilizing revenue. All indicators have given a signal that money supply from the central bank will increase significantly in the days ahead. The central bank will have to monitor strictly on the financial sector, such that the speculating sector like housing or capital market will not get excessive fund. Excessive investment in the speculative sector led the global recession in 2007. Ensuring private sector credit growth in productive sector is the only way to bypass the speculative sector. The credit growth stood at 8.6% last fiscal year, much lower than the actual targeted of 14.8%. The central bank has also kept unchanged the credit growth target for this year, and these will be the main points for the economy, how the private sector actually utilize this money, and how are they actually reluctant to take the money, or they are willing to take the money. We know that there is both demand shock at the world level. People are demanding lower products. They are taking lower sort of consumer durable goods as well as textiles. So there will be tough for the private sector to grow uh, without improving the demand side uh, for the world in the worldwide. The domestic credit growth was targeted 15.9% last year, and actually we achieved 13.7%. And thanks to lower private sector credit growth, as it contributes almost 85% of the total domestic credit growth. Though the public sector credit growth was much more higher, but private sector credit growth also frustrating performance. Banks are not willing to provide money to the private sector, as there is higher chances of non-performing loan, and last year treasury yield was much more higher, so banks prefer to invest in treasury yield. But in this year treasury bill, actually the rate of the treasury bill already declined to 5.5%. So there might be some sort of domestic growth, and BB actually targeted 15% domestic credit growth for the first half year and 19.3% domestic credit growth for the next half year. It will be tough without actually without improving the private sector credit growth. So we have to wait actually what's going to be happening in private sector credit growth. So there are some major observation regarding this monetary policy. Monetary policy faces risk factors like we know COVID-19, price volatility, global economic downturn, and floods and other natural shocks as well. So projected output growth is found to be on target if COVID stimulus situation improves and global and domestic economy recovers. Otherwise, it will be tougher to maintain 8.2% GDP from this current level. Deficit in current account balance is expected to slightly deteriorate as our export will be going down in future, but we have to raise our import to actually support the government's ADP admits Bangladesh Bank admits that remittance might not be sustainable, and this is actually a figure. Though the remittance has risen to the uh, its base level, I think, but going forward there will be tougher to maintain this remittance, as there is there is no person is going to the foreign countries for earning in in the last 2 months, and there are a lot of person who are actually in foreign countries have lost their jobs, so they have to return to their country. So there might be a pressure in remittance as well, and the non-performing loan will be higher actually because the business are performing very badly, so banks have to consider their performance, and there might be some sort of non-performing loan as well. And if banks lend aggressively to the private sector, there might be some sort of NPL boom. Taka remains slightly overvalued, and actually it was after a very long time recognized by Bangladesh Bank, and to me Taka was actually overvalued by 9 to 10%, and Bangladesh Bank should devaluate our currency to increase our export level, to increase remittance, and to increase and to improve our net foreign assets as well. But otherwise, but Bangladesh Bank though recognize that Taka is overvalued, but they will be actually intervening the market to make it stable. Bangladesh Bank expects stock to rebound in view of the supportive monetary policy, and I personally believe so. There will be lots of fund in the capital market in the short to medium term, so there might be some sort of bullish trend in capital market for the medium term, and money velocity may fall further in 2021 for COVID-19, as people are keeping money in their hands. They are not depositing as much uh, as predicted, so there might be some sort of money velocity fall further in financial year 2021. These monetary policies statement, and thanks for being with us, and follow us Bangladesh at a glance on Facebook. Thank you all for having your patience.